The film opens by examining the financial deregulation that took place in the 1980s, setting the stage for the economic collapse decades later. Before deregulation, the financial industry operated under strict guidelines designed to prevent excessive risk-taking. However, starting in the Reagan era, major policies began to shift in favor of Wall Street interests. Key figures such as Alan Greenspan, who served as chairman of the Federal Reserve from 1987 to 2006, played an instrumental role in promoting deregulation. Under his leadership, financial institutions were given more freedom to engage in speculative investments. This period saw the rise of investment banks, hedge funds, and insurance giants such as AIG, all of which became major players in the crisis. During this time, derivatives, complex financial instruments that derived their value from other assets, became widely used. The most notorious of these were collateralized debt obligations, CDOs, and credit default swaps, CDSs, which allowed banks to make risky bets on mortgage-backed securities without proper oversight. The banking sector was also undergoing rapid consolidation. Major firms such as JP Chase, Citigroup, and Goldman Sachs became increasingly dominant, gaining influence over policymakers and regulatory bodies. The result was an industry that prioritized profit over stability, leading to the emergence of a high-risk financial system. With deregulation in full force, the housing market became the epicenter of Wall Street's risky behavior. Banks began issuing subprime mortgages, loans given to borrowers with poor credit histories, at an unprecedented rate. These loans were bundled together into mortgage-backed securities, MBS, and sold to investors as seemingly safe assets. Credit rating agencies, including Moody's, Standard & Poor's, and Fitch, played a significant role in legitimizing these toxic assets. They assigned high ratings, a AAA, to securities that were, in reality, extremely risky. Because of these inflated ratings, pension funds and institutional investors poured billions into these products. Unaware of the impending disaster, investment banks continued to push for more mortgage lending, leading to predatory practices. Lenders encouraged borrowers to take out loans they couldn't afford, often using deceptive tactics to convince them that housing prices would never fall. At the peak of the housing boom, banks even provided loans with little to no income verification, a practice that would later contribute to massive defaults. Simultaneously, Wall Street executives and traders engaged in reckless speculation. Leveraging became rampant, with firms borrowing vast sums to maximize their investments. Some banks had leverage ratios as high as 33-to-1, meaning they had borrowed $33 for every $1 they actually owned. By 2007, the housing bubble had reached its breaking point. Home prices began to decline and mortgage defaults skyrocketed. In 2008, the financial system unraveled at an alarming pace. Lehman Brothers, a 158-year-old investment bank, filed for bankruptcy after its exposure to toxic assets became unsustainable. This event sent shockwaves through global markets, leading to panic and a liquidity crisis. AIG, one of the largest insurance companies in the world, was on the brink of collapse due to its massive involvement in credit default swaps. Because AIG had insured billions in risky mortgages without sufficient capital reserves, its failure threatened to destabilize the entire economy. The U.S. government intervened with a historic $700 billion bailout known as the Troubled Asset Relief Program, TARP. While this program was designed to stabilize the financial system, it also sparked outrage, as taxpayers were forced to rescue the very institutions that had caused the crisis. Meanwhile, millions of Americans lost their homes, jobs, and savings. Despite the devastation, Wall Street executives continued to receive massive bonuses. Firms such as Goldman Sachs, which had contributed to the crisis, reported record profits and rewarded their employees with billions in compensation. This glaring disparity between the suffering of ordinary citizens and the wealth of financial elites fueled public resentment. One of the most shocking revelations in Inside Job is the lack of accountability for those responsible. The documentary exposes how top executives, government officials, and economists who played key roles in the crisis faced no legal consequences. Charles Ferguson highlights the revolving door between Wall Street and the U.S. government. Many individuals who held regulatory positions later transitioned into lucrative banking jobs. For example, Henry Paulson, former CEO of Goldman Sachs, became the U.S. Treasury Secretary and oversaw the bailout. Similarly, Lawrence Summers, who championed deregulation during the Clinton administration, went on to serve as President Obama's chief economic advisor. The film also criticizes academia for its complicity. Prominent economists at institutions like Harvard and Columbia were found to have financial ties to Wall Street, raising ethical concerns about their research and policy recommendations. Despite overwhelming evidence of fraud and misconduct, no top executives were prosecuted. Instead, banks reached settlements with the government, paying fines that were insignificant compared to their profits. This lack of justice reinforced the perception that the financial industry was above the law. As the documentary concludes, it examines the long-term effects of the crisis. Unemployment remains high, home foreclosures persist, and income inequality has worsened. While some reforms, such as the Dodd-Frank Act, were introduced to regulate Wall Street, many believe they were insufficient.